Welcome back to The Deep Dive. We're here again to sift through a pile of financial sources and pull out the key insights for you.
And today, we're looking at a fascinating quarter for one of the big global brewers, Q3 2025.
Fascinating is the right word. Because you look at the background, inflation's still sticky, geopolitical issues simmering, and really unusual weather hitting key regions.
Absolutely. I mean, conditions were definitely challenging. But despite all that, they delivered growth, both top line and bottom line. And maybe most importantly, expanded their margins.
Which feels like a paradox, right? Because our mission today is figuring out how they did that when, their total volume actually dropped 3.7% in the quarter. That's a big number.
It really is. And the answer seems to be very effective pricing combined with smart portfolio management. Overall revenue was only up slightly, 0.9%.
Okay.
But the key metric, revenue per hectoliter, that's per 100 liters of product that shot up 4.8%. That's a substantial increase.
And that strong pricing, that's what let them boost profits.
Exactly. It fueled a 3.3% rise in normalized EBITDA. And the margin itself, it expanded by 85 basis points.
So 0.85%, pushing their total margin up to 37%, that's pretty healthy.
Very healthy. It really points to a strategy of, well, maybe selling a bit less overall, but making sure what they do sell is higher margin and commands a better price.
Okay, let's unpack that strategy. Pillar 1 is leading growth. This seems to be about premium products and innovation. Their big global mega brands did well.
They did. Combined revenue for those was up 3.0%, and Corona is just a perfect example of this.
How so?
Well, outside Mexico, it's home turf. Corona's revenue jumped 6.3%. And get this, volume grew by double digits in 33 different markets around the world.
Wow, 33 markets.
Yeah. It shows they're successfully exporting that premium image globally, not just relying on domestic strength.
But I do wonder, is this premium push sustainable long term? Is it just, masking saturation by hiking prices? Eventually, don't you risk alienating some consumers?
That's definitely the key question. But based on what they're saying, it looks like they're trying to broaden their reach, not just raise prices on existing stuff. They talk about balanced choices.
Right, bringing more people under the tent, so to speak.
Exactly. It's about growing the total addressable market with categories beyond just traditional beer.
Which brings us to non-alcohol beer. That seems to be exploding.
It really is. That portfolio saw revenue growth of 27% in Q3. They're leaning right into that trend towards moderation.
Any standout brands there?
Michelob Ultra Zero in the U.S. is a big one, launched just this year, and it's already the #2 NA beer brand there.
Yeah.
And the fastest growing.
That's impressive speed.
It is. And Corona Cero is right there, too. Volume's growing in the low 40% range. It means they're now estimated leaders in the NA space in 8 of their top 14 markets for it.
Okay, NA is growing fast. But the Beyond Beer category? That seems even faster. Another 27% revenue growth there.
Yeah, that's the real catalyst for innovation, arguably. It's still small, maybe only 2% of total volume right now.
But more profitable.
Significantly more profitable per hectoliter than the equivalent beer products. So it's crucial for that margin expansion we talked about.
And the star player in Beyond Beer has to be Cutwater, right? Especially in the U.S.
Cutwater's performance is, well, phenomenal. Triple-digit revenue growth. It's getting close to $500 million in annual retail sales.
$500 million?
Yep. And it's cracked the top 10 spirits brands in the U.S. And maybe more tellingly, it was the #1 share gainer in the entire spirits industry in August and September.
So they're not just stealing share from other beers, they're genuinely disrupting the spirits market.
Precisely. And then there's the new venture, Form Energy, also in the U.S.
Right, focusing on clean energy. What's the strategy there?
It signals they aren't just stopping with ready-to-drink cocktails like Cutwater. They're looking for that next big thing in wellness and functional drinks. It's a clear move beyond their brewing roots.
Using that massive distribution network they have.
Exactly. Becoming more of a total beverage company, identifying where consumers are moving, whether it's low-no alcohol, spirits, or even energy.
Okay, let's shift gears to Section 2. Regional performance. It sounds like Q3 was a bit of a roller coaster, depending on where you look. North America, for instance. Revenue down slightly, 0.7%.
That's right, a small dip overall. But, and this is important, they still highlighted market share gains.
How does that work? Revenue down, share up?
It comes down almost entirely to Michelob Ultra. That brand is now #1 by volume in the U.S. for the year so far. Gained share in every single state.
Wow, all 50.
Yep. So while the total market might have had some pressure affecting overall revenue,
Yeah.
Ultra is winning strategically. And the interesting part is the potential runway it still has.
What do you mean, Roy?
Well, nationally, Michelob Ultra has about an 8% market share. In its best states, it hit 16%. But the sources point out there are still 20 states where its share is below 6%.
So the number one brand nationally is still underdeveloped in nearly half the country.
Pretty much. It suggests there's still huge organic growth potential just by closing that gap in those lower share states. It's quite striking, actually.
That really highlights the organic potential. Okay, let's head south to Latin America.
Okay.
That's about a fifth of their global beer volume, right? And hit hard by bad weather.
Very hard. Colder temperatures, more rain than usual. It really dampened results, especially in Brazil.
How bad was Brazil?
Revenue there was down 1.9%, but that was driven by a really sharp volume decline, down 7.9%. Beer sales are just very sensitive to weather.
Okay, a nearly 8% volume drop. You'd expect profits to take a big hit.
You would.
Mm.
But remarkably, their EBITDA in Brazil was flat, and they actually expanded margins there.
Flat profits despite that volume crash. How?
It points to incredible operational agility. They must have been able to cut back costs, probably on lower margin products, almost immediately as volumes fell. It wasn't just cost control, it showed real flexibility.
And the premium side helped too.
Yes, they mentioned mid-teens volume growth in their premium and super premium beers, which obviously carry much higher margins. That helped offset the mainstream volume loss.
Impressive resilience. What about other parts of Latin Mexico?
Mexico also saw volumes dip initially because of the weather and maybe some consumer sentiment issues, but they said it started growing again sequentially in August and September as things improved.
Okay, a recovery there.
And then Colombia was actually a bright spot, delivered record high volumes, drove double-digit revenue growth, and mid-single-digit profit growth. So LATAM was really a mixed picture, driven by local conditions and some very nimble management.
Got it. The last big region to discuss is Asia-Pacific, mainly China. That looked challenging. Revenue down over 15%, volumes down over 11%.
Yeah, China faced some definite headwinds. They pointed to weakness in certain channels, especially on-premise, so bars and restaurants weren't as strong. And they also took specific actions to manage inventory levels.
So some of that volume drop was deliberate?
Apparently, about a third of it was due to consciously reducing inventory in the system, a corrective measure they think will mostly be done by the end of Q4.
So it sounds like less of a strategy problem and more of an execution and inventory adjustment phase.
That seems to be the narrative, yes. They're refocusing investment on their big brands there, improving how they reach consumers for in-home drinking and through online channels, and pushing innovation like Budweiser Magnum and even a new full open lid Corona can.
A full open lid for the lime ritual at home.
Exactly, trying to replicate that bar experience at home. So yeah, it seems more like tackling execution hurdles than a fundamental demand issue right now.
All right, let's move to the third pillar, digitization and capital discipline. The B2B platform, BEs, comes up a lot. It sounds like more than just an ordering app.
Oh, it's absolutely a core strategic asset.
Yeah.
A real competitive advantage. The total value of goods sold through it, the GMV hit $13.3 billion this quarter. That's up 11% year over year.
$13 billion, that's huge scale.
It is. But what's maybe even more interesting is the BE's marketplace component.
That's where they sell other companies' products too, right? Not just their own beer.
Exactly. And that marketplace GMV grew 66%. It's getting close to $1 billion per quarter.
So they're leveraging their distribution network to become a wholesaler for other products too.
Pretty much, it makes their platform stickier for retailers and harder for competitors to bypass. They're monetizing their route to market itself.
And there's a direct-to-consumer side as well.
Yep. D2C platforms like Zed Delivery, they generated $138 million in revenue in Q3 from nearly 12 million active users. That gives them direct consumer data and builds loyalty.
Okay, finally, let's touch on capital allocation, the optimize our business part. Sounds like they're feeling pretty good about their financial position.
They definitely seem confident. They reiterated their target of keeping net debt around 2 times EBITDA, which they see as optimal. And that stability allowed for some big announcements.
Like the share buyback.
Exactly. A new $6 billion share repurchase program over the next 2 years. Plus, they redeemed $2 billion in bonds early.
And the dividend news was significant too, wasn't it?
Very significant. An interim dividend of $4.15 per share. That's the first interim dividend they've paid since way back in 2019.
That sends a strong signal, doesn't it? Confidence in future cash flow, ability to grow organically first, and still return cash to shareholders.
Absolutely. It's a strong confirmation. that they feel they've navigated these headwinds effectively, proven the resilience of the premium strategy, and are now in a position to both invest and reward shareholders.
So, wrapping things up for the listener, the big picture seems to be one of, well, resilience, managing to grow profits and margins even when overall volume slipped thanks to premiumization and really pushing into new areas like non-alc and beyond beer.
Right. And they sound pretty positive about the future, too. They kept their full-year guidance for 2025 at 4–8% EBITDA growth range, and they're already looking ahead to some big potential boosts.
Like the World Cup.
Yeah, the FIFA World Cup in North America in 2026, they specifically called that out. Historically, events like that have given a nice lift to the industry, maybe $0.20 a tam to 14 and still a 25 per share impact on the category.
Yeah.
And the 2026 tournament has more games, right, in key markets.
Huge potential there. And they have other sponsorships, too.
They mentioned a new UEFA Champions League sponsorship starting in 2027 as well. So continuing to tie their brands to these massive global sporting and cultural moments.
Okay, so given all that, the premium push, the non-alc growth, the beyond beer explosion with Cutwater and now Form Energy, here's something for you to think about. We heard the traditional beer market generally grows maybe 1% volume in normal times. Beyond Beer is currently only about 2% of their total volume.
Right. Still small, but growing fast.
So the question is, how quickly can those innovative, higher margin categories like Cutwater actually scale up from that 2% base to meaningfully contribute to or even exceed that typical 1% industry growth? And maybe more importantly, what are the real operational hurdles in integrating things like spirits and energy drinks effectively into a massive global system built primarily for brewing beer?
That's the multi-billion-dollar question, isn't it? Making those different supply chains, high-speed energy drinks, regulated spirits, traditional beer, all work together efficiently under one roof, globally. Solving that integration challenge is probably key to unlocking the next phase of margin growth.
A complex puzzle for sure. That's our deep dive for today. Thanks for joining us.
Talk soon.